Hopefully we're all adjusting to this cold weather, certainly here in Sydney. It's been a bit of a shift. First day of winter today and certainly can feel it. All right, well, we'll kick off. Firstly, apologies for having to postpone from last week. I was down with the flu last week and my voice just wasn't up to it last week. I wouldn't have been able to last. So we've had to push it back, but great to have you all here today. We've had over 120 registrations for this webinar, which is fantastic. So obviously a popular one. So looking forward to digging into lots of content today. For those of you who don't know me, I'm Mark Williams, and I'm really proud to be the Managing Director of Imagine Accounting. We have a great team, fantastic clients, and we've been helping hundreds of small businesses and individuals for over 20 years now. We are recording today's webinar and we'll be sending a copy of the recording to everyone who attends and is registered. If you've got any questions throughout, feel free to put them in the chat. Jen will be monitoring the chat and if she thinks they're relevant, we'll raise them. Otherwise, we'll have some question time at the end. Also, appreciate if everyone can remain muted throughout, just so there's no background noise and echoing. As I mentioned earlier, we've got heaps of content. There's over 80 slides. We're covering everything in terms of individuals, businesses, superannuation, year-end tax planning, structuring. There's heaps of stuff in there. Just really want to cover as much as possible. So with the current environment, recent change in government, inflation where it's at, interest rates on the rise, changes in super, there's a lot for everyone to think about. So just want to make sure you're across all the recent changes and opportunities. All right, we'll jump in. Hopefully you can all see my slides, see my screen, and see me and hear me okay. We'll get going. All right, so firstly, the disclaimer that this is not advice, so you can't act solely on the basis of the information that's in here. Obviously, seek professional advice before acting is the disclaimer there before we jump in. All right, so what we'll cover, we'll kick off initially with an overview of tax planning. What is it? We'll then have a look at end of financial year and tax minimisation strategies broken up for individuals, businesses, and then superannuation and pensions. We'll then have a look at upcoming changes that are kicking in from the 1st of July, affecting individuals, businesses, and super, and then also some announcements out of the recent election and Labor policies that may well come in shortly. So let's jump into it. Firstly, overview of tax planning. So just, quick quote here from the great man, Mr. Einstein: the hardest thing to understand in the world is the income tax. So it certainly is here in Australia. They've talked about simplifying for a while, but doesn't seem to be heading that way. So firstly, to cover off, what are we looking at here? We're talking tax minimisation. So everything we can do within the realms of the law that is, compliant with the law and legislation. So, which is totally okay. We're not talking tax evasion, which is illegal, and not doing things that we can do, obviously. And a great quote there, which I love, from Kerry Packer in relation to contributing to government funds and that they don't always spend it as well as they should. So why should we give them any more than we need to? Anyway, let's kick off. So rules of the game in terms of components of tax planning, what are we talking? There's obviously different levels of taxes, federal taxes, which are income tax, capital gains, GST, FBT, state taxes, which typically comprise payroll tax, land tax, and stamp duty. We've got different tax rates across different structures and also depending on residency, which we'll touch on soon. And then obviously compliance is a big thing to make sure that we're all complying with our lodgements and compliance obligations. So why is this so important? Most of you would be aware of the importance of tax planning and what we can achieve. Here are some examples. You can be talking significant amounts of money if you get tax planning right. So there's opportunities in terms of restructuring there, which we've done previously with significant liabilities in the company that had needed to go through liquidation. There was a restructure there, a restructure in terms of changing a fast-growing business with initial savings there of 30,000. We did a sale of business and applying small business concessions there. In that case, a $4 million sale value with nil tax payable. Change of ownership, main residence exemption from land tax there. We achieved a are looking to achieve, working with the client at the moment, achieve an annual 10K saving in land tax, getting the main residence exemption applied there. Liquidation, extracting $8 million of tax-free capital gains. So that's an older company that had that within its structure. Retirement planning within superannuation, you can strategies such as CGT cost-based resets can lock in millions of dollars in tax-free gains if you're within pension mode at zero tax within super. Wills and estate planning, so in that scenario, planning to withdraw funds from super to effectively save $500,000 in tax, which would have been paid if the monies had gone into the estate post-death. Payroll tax, restructuring the way we take money out of a business and owner remuneration and achieving a $15,000 payroll tax saving there we did a number of years ago for a client. Okay, so rules of the game, quick overview of the tax rates in Australia. This is for residents. So you can see on the left there, we've got the top individual tax rate at 47%. And you need to add on the Medicare levy down the bottom there of 2%. So effectively it's 49%, pretty much 50. Then we've got companies which are taxed at 30%, unless you're an eligible business entity, which are now taxed at 25% and no 50% CGT discount within companies. Trusts and partnerships typically don't pay the tax. Beneficiaries and partners pay the tax. And if a trustee doesn't distribute the income, the trustee pays the top rate of tax within a trust if the income isn't distributed. Then we've got on the right, we've got superannuation funds, which is obviously the ideal result in terms of zero tax there when in pension mode on up to a $1.6 million balance in super. Otherwise, the standard tax rate is 15% or 10% on capital gains tax on assets held more than 12 months. So that's the tax rates that we're talking. Then we need to consider income versus capital. Typically, capital gains are taxed more concessionally than on income account. We've got the 50% general discount, and we've also got CGT small business concessions there, which can significantly reduce the rate of tax to pay. Then we've got residency, so there's the non-resident tax rates in there. So if that's relevant to your situation in terms of residency and how we manage residency, obviously the tax rates are significantly higher there. You don't have those lower tax-free thresholds and tax rates. You're paying tax at 32.5% from the first dollar as a non-resident in Australia. Okay, we'll move on to strategies for individuals. So firstly, just covering off on substantiation. We're probably all aware of this, but you need to be able to substantiate your claims, keeping logbooks for motor vehicles, phone usage, travel diaries, etc. And you need to keep them for 5 years from the due date of lodgement of the tax return. Work-related expenses, so there's a list of there though. So basically anything that you incur in relation to earning your income, your employment income, usually is deductible, and there's a list of those there. So have a think what might apply to you, any training, education, travel, union fees, subscriptions, internet, etc. there. Home office expenses is obviously a big one, has been for the last couple of years with COVID. We've got 3 ways that we can calculate and claim home office expenses. The first one is the shortcut method, which is a standard, which is 80 cents per hour, per work hour. It's available only until the 30th of June, so this financial year. It's a temporary method, calculation method that the government have brought in during COVID. If you do use that method, you can't claim any other expenses for working from home. So it's just a simple method based on hours multiplied by 80 cents per hour. Then you've got the fixed rate method, which is 52 cents per hour, sorry. It covers electricity and running costs, and you can still claim other costs. So a little bit more work to do in calculating that. Then you've got the actual cost method. So basically adding up all your actual expenditure. So typically you do an analysis of all 3 and work out what's going to give you the best result there. Other thing to be mindful of is running costs, which typically apply to most people. And that's really your home office expenses, your running expenses when you're working from home or choose to work from home. To be able to claim occupancy costs, which are things such as mortgage interest, rates on your home, insurance, that sort of thing. Typically, you need to be running a business from home, genuinely, or in very limited circumstances as an employee. So that doesn't apply to too many people, but just important to be aware of that distinction there. Okay, so motor vehicle expenses, there's two methods we can use to calculate motor vehicle expenses. The first one is a logbook method, in which you need to maintain a logbook for 12 consecutive weeks, and the start date must be on or before the end of the year to be able to use that as a logbook for this year. Keep your odometer reading as well. Keep all your receipts and invoices. So you basically add up the total motor vehicle expenses, work out depreciation on the vehicle, work out interest if you've got debt or finance on the vehicle, and then multiply it by the business percentage that the logbook calculates, and that's your claim. Otherwise, there is a cents per kilometre claim there, no logbook needed, and you can claim up to 5,000 business kilometres in that instance. Okay, other deductions, so donations, you need to ensure that the donation is made to what's called a DGR, deductible gift recipient. So that's normally on the receipt that you get from them. There is a strategy to distribute income via trusts to income tax exempt entities such as charities. So that can achieve effectively a tax benefit or tax deduction for the donation if they're not a deductible gift recipient. So some churches and schools and other not-for-profit organisations may not have DGR status, but we can potentially make trust distributions to them and achieve a tax deduction in that regard. Income protection insurance, if that's relevant for you, make sure you're claiming it. It's an easy one to miss, but that certainly is deductible. And then superannuation concessional contributions are also deductible. The cap now is 27,500 for the current year. And we can also utilise unused caps from prior years. So back to the 1st of July 2018, if your super balance is less than $500,000, that basically means you can potentially contribute $100,000 in the current financial year. So that's a really great strategy to consider if you've got a lumpy income this year or high income. You might have a capital gain on the sale of a property or other assets, or you've got a high income from business or salary or whatever it might be, and you haven't used your full caps in previous years, you might want to consider doing that this year. So if you're between 67 and 75, you need to pass the work test, although that is being abolished from 1 July. And there is 15% tax on super contributions, so you need to weigh that up in terms of the tax benefit you're getting at your marginal tax rate typically, or rates if it goes across multiple thresholds, versus the 15% contributions tax going in. Also need to consider Div 293 tax, which is basically additional tax on super contributions if your adjusted taxable income is more than $250,000, and that's an extra 15%. So we've got to weigh that up as well. So if you're at that level of income, have a look at trying to plan to get your adjusted taxable income under the 250K, ideally, to avoid that additional tax on super contributions. Okay, some other strategies. Salary sacrifice, usually worthwhile from a tax perspective, particularly, especially for not-for-profit employers. Reason being is they have FBT exemptions or rebates that they can apply, which they usually pass on to their employees. So it means you can salary package private expenses, for example, which ordinarily would attract FBT for a normal employer, and usually they're not worthwhile. But with not-for-profit employers that have that exemption or rebate, it can be worthwhile. So if you are employed, they're certainly worth considering that and often utilising the full caps if you can. Other things to salary sacrifice are superannuation contributions, and also motor vehicle there as well. Bonus payments, that's another one to consider, how they're accessible and when you receive those and whether any opportunity to move those. Travel expenses, they can be tax-free. So if your employer does pay you a travel allowance, it can be tax-free. So that can be an effective one to look at with your employer. Or if you're a business owner and you're doing travel, you might want to consider paying yourself a travel allowance because the business will get a tax deduction for it, and you as the employee are not taxable on that, potentially up to the relevant daily rates. So that's worth considering. And then private health cover there, if you don't have private health cover and you're above those thresholds, 90K as a single or 180 as a family, you'll be up for the Medicare levy surcharge, which is additional tax. And the longer you wait to take on private health cover, the more expensive it gets. So the insurers up their premium. If you join later in life, if you join at age 40 or 45 or 50, your premium is going to be relatively quite a bit higher than you would if you joined, at a younger age, and that's obviously what they calculate in terms of fairness in the health system. Prepaying expenses and interest. So this can be worthwhile in terms of bringing forward deductions in relation to investment activities. So you might want to look at prepaying interest on a loan into this year. You can prepay up to 12 months in advance. Talk to your lender about that. You can also prepay other things such as insurance, repairs, memberships, bring them forward into this year. Particularly works well if you've got a higher income this year than you might next year, and your marginal tax rate is going to be higher this year than next year. You're going to get an overall tax benefit there. Otherwise, it's purely a timing benefit. You're bringing forward the deduction to this year. If your income is going to be similar next year, you're just bringing it forward into this year. And then, of course, accounting fees at the end there. We do have clients approach us asking for our invoice in June so that they can claim that this year. So certainly reach out if that's something you're interested in. Rental properties. So just being mindful of repairs, which are typically deductible, versus improvements on properties, which are typically capital. That does depend on the type of expense. So reach out to us if you're not sure which bucket they would sit into, but quite a different tax result there. If they are capital, typically have to be written off over quite a long period, and you're not going to get the full write-off upfront. And then secondly there, ensure you have a property depreciation report, which are prepared by quantity surveyors to make sure you're claiming all the relevant depreciation and capital works on the property that you should be. And we often see this, particularly with new clients. They've got investment properties and they haven't obtained a depreciation report previously. So that's definitely something that we usually recommend. It costs about $500, $600, somewhere around that, to get a quantity surveyor report. That cost is deductible, and then they'll do an assessment of all the fixtures, fittings, and the capital value of the property, or your share of it if it's a unit, for example, and then calculate what your entitlement is to write off over a period. So it can add up to thousands, even tens of thousands of dollars in deductions. So very, very worthwhile doing that. All right, so this is in relation to capital gains and also investment income. If you can defer income, so again, really from a timing perspective, can we be pushing income back into next financial year, i.e. after 30 June? So particularly around capital gains, just be mindful that capital gains are triggered on contract date, not on settlement. So if you're selling a property, it is based on contract date. So if you sign the contract in June and you don't settle till next financial year, the capital gain is triggered and taxable in the current financial year. So just be mindful of that. And also considering that 50% discount if you do have assets and are potentially eligible for that, have a look at the timing. You wouldn't want to be selling an asset if you have held it for 11 months, for example. It might be worth holding it that extra month and getting a 50% discount on the capital gain. Okay, realising capital losses. So tax is normally payable on gains, so including crypto and digital assets. So if you do have capital gains this year, if you sold shares, sold crypto, sold a property, and you've got capital gains, if you do have other investments that are sitting on losses, unrealised losses, might be worth realising those losses, i.e. selling those investments. You can always buy them back if you want to, but you would actually need to sell them, realise the loss. You can then claim that loss against your other capital gains. So that might be relevant, particularly with crypto at the moment, with the share price, or the crypto prices have tanked. So people may have unrealised losses on crypto that might be beneficial to sell, realise the loss, then you can buy back in if you choose to do so. But you've got that loss then you've realised to then offset against your gains. Just to note that unused capital losses will be carried forward, can be carried forward to offset future capital gains. You can't offset capital gains against your other income. They are quarantined and can be only offset against capital losses. Ownership of investments. So this is something always to have a think about when you're investing, even if it's in cash, not that cash is earning much money at the moment, but if you're putting money into term deposits, or if you're buying shares or buying a property, always suggest reaching out to us or to your accountant, and ensuring that it's in the right structure and that the income therefore and the capital, future capital gains are going to be in the best entity or the best structure. To change it later, we have to consider capital gains tax and stamp duty if we want to change it later, so ideally getting it right up front. But things such as investing in a lower income earner's name, and again, I've seen that a number of times before, where property might be sold, the sale proceeds, they might be buying another property, they're putting $500,000 or $1 million in the bank or in a term deposit, and it's in joint names, and there's one high income earner, one low income earner. Would have been a much better tax result to just put that account in the name of the low income earner, and can result in substantial tax saving there. And then obviously considering using a trust as well, if that's relevant, which we'll talk about a little bit later. Okay, that's individuals. So we will jump into strategies for business. So first tool, number one tool really that we've got in terms of tax planning is structure and getting our structure right. And it's always a question, do you have the optimum structure? Really should be looked at on a regular basis, sort of at least annually. Are there any opportunities to change the structure, improve your structure? And as I mentioned, when you're undertaking investments, particularly buying property, make sure you're getting the structure of that right up front. And they're the different structure options, which we won't drill into today. We do need to consider if we want to change structure. As I mentioned, we're up for considering capital gains tax, stamp duty on property, depending on your state. Stamp duty is state-based tax. Value shifting can apply in relation to shares and issuing shares or cancelling shares. Then we've got small business CGT concessions, we've got CGT rollovers, and then considering the costs in relation to structure as well, which is a cost benefit. We also want to consider timing on when CGT is triggered, and also the ability to pay dividends in relation to the 45-day holding period rule. So often we might look to do a restructure, and very often happens around the end of the year, maybe in June, but we need to be mindful that we're not going to be or have an issue with meeting the 45-day holding period rule to be able to pay dividends. So if we did a restructure now and the ownership of shares changed, we then have an issue potentially meeting the 45-day holding period rule in relation to paying dividends on the 30th of June, which means that franking credits potentially can't be passed on. So that's something that we need to be mindful of in terms of timing when we're looking at structure. So this is more from a structuring and asset protection perspective as well, in terms of splitting business assets from your trading entity. Are they in the right entity? If you're acquiring assets, consider whether it should be done within the trading entity or not. Often it's not great from an asset protection point of view to do that. So always, again, reach out in terms of how best to structure that really. One challenge that we do have in relation to purchasing assets and equipment, for example, is the immediate asset write-off. In that if we do set up, say, an asset holding entity and it's a non-trading entity, it won't be eligible for the immediate asset write-off. So that's a challenge we've got to manage in terms of how we structure things and making sure we're getting the immediate asset write-off, for instance, but is it also optimum from an asset protection and overall structure perspective? Okay, next one here is trust distributions and assessing beneficiaries within a trust. Trusts typically give us the most, and certainly discretionary trusts, give us the most flexibility in terms of splitting income and distributing income. So we'd normally be assessing potential beneficiaries, which we have to look at the deed and see who is eligible as a beneficiary under the deed. We can also consider bucket companies as well. So if that's relevant for you, need to make sure we've got the company formed before 30 June. And I've seen not too long ago a accountant suggest using a bucket company that wasn't formed until after the end of the year. You simply can't distribute to something that's not formed in that year. So that's an important one that we need to assess and make a decision on, and form a new company, if so, before 30 June to make sure we are able to distribute. And then we've got to consider what tax rate that company will be taxable at, whether it's eligible for the lower 25% rate or otherwise at the 30% rate. And I mentioned that earlier in terms of gifting and donations to a church or charity, for example. We can potentially look to use a trust to achieve a tax benefit of doing that. So another thing with trusts is the ability to stream. Again, it's dependent on the trust deed and whether it allows it. But we've got typically 3 categories of income that we can stream. First category is capital gains. So we can break up the components of the income and say capital gains for this year can go to an entity or individual. And there may be an entity or individual with capital losses that we can utilise. So that may make sense to distribute and stream that component of the income. Franked dividends, for example, we might want to distribute through a bucket company. And if it's a fully franked dividend, there's typically no further tax to pay. Or we might want to distribute through to a non-resident. So that can be a good strategy if you've got a non-resident within the family. It can be a way of capping the tax rate to get money out of a company structure by distributing to a non-resident, because fully franked dividends to a non-resident have no further tax implications in Australia. Obviously need to consider the implications in whatever country that individual resides, but that can be quite a nice strategy if that works for your situation. And then other income, basically the remainder of the income can then go to the lowest taxpayer. So that's a really useful one to be aware of in terms of trusts and categories of income. And if anyone's got a trust, hopefully you're all aware that we need to make trust resolutions by the 30th of June. And if not, default beneficiaries are subject to the tax, or the trustee will be assessed at the top rate of tax. So that's a really important one. We will certainly be writing to all our clients that have trusts before the end of June, letting them know and making sure they're aware that they need to be preparing those minutes or resolutions and that they're on file. And also to note there, any new beneficiaries of a trust need to be notified by the 31st of July as well. So if that's relevant for you and you've got new beneficiaries this year, you do need to notify the ATO with the TFN declaration by the end of July. In relation to trust, there has been a major crackdown, and many of you have probably seen that in and around the news, and the ATO's application of their interpretation of legislation and the regulations around trusted distributions. And they're basically wanting to target distributions made particularly to adult children or adult dependent children or company beneficiaries where the money's actually not flowing through to them. So what they're really wanting to be seeing is if you're distributing to a child, for example, or distributing to a company, then the funds and the cash should really follow, and the distribution should be actually made to them. It shouldn't just be sitting on the books as owing to them, and they really can't be gifting it back to you either. So that's a really important one to be aware of. So if that's relevant for your situation, definitely have a think about that and be talking to us or talk to your accountant about how you're managing that and how you plan to manage that for this year. It's a big change in relation to trusts, and we need to manage it well. The ATO do have the ability to apply it retrospectively as well and go back a number of years to what's already been done. That's what they've indicated. We'll see what unfolds in that regard, but we can't change what's already been done. That's been done, but we can deal with the current financial year and what we do this year. So just really need to be aware of that one if that's relevant. Okay, so in terms of companies, so a strategy there to be able to split income potentially is looking at and considering different share classes. So most companies are set up with ordinary shares, and say they're set up with 2 partners or mum and dad 50-50. In that case, any dividends that flow out or any future capital gains that are flowed out as dividends or from any sale need to go in that ratio, and you're fixed in terms of the ownership ratio of ordinary shares, for example, 50-50. So what we can consider is different classes of shares. So you might have an A class or a B class or C class, in which case directors can then choose to pay dividends to a certain class of shares. So then provides the flexibility. We might only want to distribute or pay a dividend to A class shareholders, and that might be mum and dad might own B class. So it gives us the ability to pay dividends to certain classes of shares. We do need to consider valuation of company and value shifting if we are issuing new shares, for example, and there are shifts in value, and also impact on CGT small business concessions, because having multiple classes of shares can impact on eligibility for that as well. So need to be mindful of that. Okay, dividends. So just need to be mindful in terms of dividends now, and franking credits particularly. So base rate entities, which are most small businesses typically, are paying tax now at 25% in the current year. Therefore, franking credits on dividends paid are going through at 25%. So just be mindful of that. You may have been paying tax at 30% previously, but unfortunately, if the company is now on a 25% tax rate, you can only just pay franked dividends at 25% franking rate. So one strategy there, the second line there, is moving frankable profits to from a trading entity to a bucket company, for example. So that can be more so from an asset protection point of view, getting profits and getting cash out of a trading entity across to another entity, and it can potentially cap it at the company tax rate with no further tax there to pay. Another one there to be mindful of is how we account for depreciation and instant asset write-off and the impact on dividends. So this is really from an accounting treatment perspective, because you might acquire a new vehicle, for example, for $50,000. It might be eligible for the instant asset write-off from a tax point of view, but we may not want to write it off fully from an accounting point of view. We might just want to claim depreciation on it in the accounts and the financials, so that we've got retained earnings. Reason being, then we have retained earnings and the ability to pay dividends. Otherwise, and then we can still maintain that tax treatment, which is basically a tax adjustment on the tax return to claim the full write-off of the asset, but we maintain depreciation in the accounts and the financials, for the reason being to maintain retained earnings to enable dividends potentially there. So it's something to consider there if that's relevant. Okay, next one is Div 7A loans, or Division 7A loans. So some of you may be aware of this. So it's a part of the Income Tax Act, which is basically targeting overdrawn loan accounts from companies, typically to individuals related to the company. But it can be a way to defer and spread tax on getting money out of a company. So if you were to draw out $100,000, say, from a company this year, but you may already be at the top rate of tax, and it may not suit to pay a dividend out this year to you because you're going to pay tax at the top rate, we can potentially treat it as a loan and enter into what's called a Division 7A loan agreement, and then deal with that loan over a number of years. And at the moment, the terms are 7 years for an unsecured loan or 25 for a secured loan. That potentially is changing to a 10-year flat loan term, but that hasn't been introduced yet. But it is a way effectively for us to spread the tax if you wanted to get money out of a company. So there's some things we need to be aware of. There needs to be a minimum repayment made each year on that loan, which includes interest at the benchmark rate there, which is currently 4.52%. We need to have a loan agreement in place, making sure that we are meeting those minimum repayments each year and that reborrowings don't occur. So if you are drawing further loan funds in another year, for example, we want to make sure we're splitting that out, and it can't be in addition to the existing loan. It needs to be treated separately. But that can be a useful strategy in terms of managing tax on getting money out of a company. Okay, next one is temporary full expensing of depreciable assets. So this is one of the rules that the government brought in during COVID. It's pretty much the same thing as the instant asset write-off, although it's a different policy essentially that's been applied, but very confusing having both and understanding what both are. But it essentially means we can write off assets that have been held, first used or installed ready for use up until 30 June next year. So this applies through to 30 June 2023. For businesses less than 50 mil, so that will apply to most of us, fully deduct the business portion of new and second-hand depreciating assets. So particularly relevant there for cars, which the car limit does apply under this, so which is about 60,000 at the moment, excluding GST. If it is considered to be a car, a passenger vehicle, i.e. designed to carry a load of less than 1 tonne and fewer than 9 passengers, we can only claim the business portion. So if you buy a car for 60 grand and the business portion is only 50%, we can only claim half of that 60 grand. We can't claim the full 60 grand. Non-passenger vehicles are different. So if they are more than 1 tonne, or if they carry deemed commercial vehicles, you can deduct the full cost. So that's when you're talking, 1 tonne plus utes or vans and commercial vehicles, etc. Then no issue with the full cost there. And yeah, we've got through till 30 June 2023 in relation to that. So the thing to be mindful there, which we're starting to see as well, where clients have purchased a vehicle in previous years, claimed the full write-off on that, and now they're selling it or they're trading it in, the proceeds are taxable. So when you do sell it, if you buy a car for 60 grand and in 4 years' time, you sell it for 20 or 30 grand, that 20 or 30 grand is taxable. So you need to bear that in mind. So it does come back to bite you in a way. You get the upfront benefit, but then you've got to deal with the sale proceeds as being taxable, as and when you sell in future.
Question coming from Steve Duffy. Does non-passenger vehicle for the temporary full expensing include farm machinery, example tractor?
It would, yeah, because that wouldn't be considered a motor vehicle. Yep, correct. Okay, so if you're a small business, so this is really in relation to the small business pools. If you're sort of a small business less than 10 mil, you can likely get an automatic deduction at the balance of your small business pool if you are carrying a pool. Most of the pools have been written off by now, but if you still are carrying it, you can get an automatic deduction for it, but you can't opt out of it, of temporary full expensing, to which the simplified depreciation rules apply. So if that's relevant for you, we can certainly discuss that in more detail. It's something that we don't really have time to dig into today on that one. So instant asset write-off, which is the second one really. So this basically applies if you're not eligible for the temporary full expensing or if you opt out of it. It does apply to businesses up to 500 mil turnover for assets acquired prior to 31 December 2020. So we're a little bit out of date here in terms of this one. It's really for last financial year, so probably not so relevant now. Okay, next one is an interesting one. So it's the loss carryback tax offset. So it's relevant if you're a company. It's a refundable tax offset where you've paid tax previously and you might be in a loss position this year. Basically enables you to recoup some of that prior tax you've paid as a result of the loss this year. So you can use your current year losses to obtain a refund of taxes paid in the prior year. So the eligibility there is pretty broad, less than 5 million turnover. We can go back to FY20 and through to the current year and get the offset by carrying back the losses where there were income tax liabilities in previous years. So we do need to note that it is limited by the franking account. So you've got to have a franking account balance there. You can choose not to carry back the loss, and the loss may be carried forward to use in a later year. It doesn't need to amend the earlier income tax returns to claim the offset, and there is a loss carryback tool to work out if you're eligible. So yeah, something that we should be mindful there of any companies that are in loss this year and you've had profits in previous years, we can potentially recoup some of those taxes paid previously. So that's the eligibility in a little bit more detail, which are pretty much covered. And the last one there, you need to have met your return lodgement obligations. So I've lodged your tax return for that income year and have lodged for the previous 5 income years. So if you're not up to date, you need to get up to date in terms of your lodgements to be able to claim this. Okay, next one here is payroll tax. So there have been a number of changes around payroll tax. I mentioned earlier that it is a state-based tax, so it applies differently in each state. They've got different thresholds and different rates. So you just need to be aware of that. The threshold in New South Wales, for example, now is $1.2 million and has been since 1 July 2020, and the rate is 4.85%. So that basically means if your payroll, which is employees and also potentially contractors if they're deemed employees, if your payroll, including superannuation and FBT, is above $1.2 million, you need to be registered for payroll tax and paying payroll tax. So for every dollar of payroll above that threshold in New South Wales, for example, you'll be paying 4.85%. So I mentioned that earlier in terms of a strategy around owner remuneration, and it might be worthwhile there, instead of the owner taking a salary and having to pay $4,850 on every 100,000 of salary, they may well consider reducing that salary or changing it and taking it as dividend or trust distribution, for example, might be an option there. Do need to be mindful of contractors, as I mentioned, if they are considered deemed employees. So if they look and smell like an employee and you're just paying them as a contractor, they're likely to be assessed as deemed employees for payroll tax purposes, and they will be caught up. So they need to really be truly independent contractors, doing work for other clients, not just for you. They have autonomy, they use their own tools and equipment and have their own responsibility, and really are genuinely carrying on their own business, and they're not just working for you. So yeah, just need to be mindful of that. Hopefully we're all on top of single touch payroll now. That needs to be up to date, and making sure we've finalised that by the 14th of July. So we've only got 2 weeks after the end of financial year to finalise that for payroll. And then if you've got an employee share scheme, you also need to make sure you're submitting that to employees by the 14th of July and to the ATO. Okay, FBT. So general principle is we want to avoid FBT because it is at the top rate of tax. It's at 47%, sorry. So generally we want to avoid it, but we need to be mindful of it. So whenever a business is providing fringe benefits to employees or associates, we need to be mindful of FBT and the impacts of FBT. And things like motor vehicles and primarily motor vehicles and potentially some other asset purchases. If there are private use components, we need to be mindful of FBT, and it really does come down to the calculation and whether it's worth acquiring it in the business, for example, versus not. And FBT is often the determining factor in deciding whether it is or not. So the FBT year is from 1st of April to 31st of March. So it is something that we should be on top of, and FBT returns are due now. They're due in June for the March year end, just gone. Okay, PSI is another one that we need to be mindful of, personal services income. So this is basically income produced from personal skills or effort from an individual. So if you are subject to the PSI rules, you are limited in the deductions that you can claim, and they're generally limited to what a salaried employee can claim. So really need to be mindful of that. If you're doing consulting or contracting type work, need to be mindful of the PSI rules and the ability that we have in terms of deductions and also splitting income. So I won't drill into more detail on that, but it is an important one to be aware of, and can very much limit our ability to claim deductions and split income and achieve, a tax overall tax, a good tax result if the PSI rules do apply. Okay, so in terms of SBE, small business entity tax planning strategies, we've got a bit of a checklist here, so we'll just quickly run through them. Understanding your asset write-off depreciation position, that's pretty clear for most people now. Typically, government stimulus payments, so just making sure we're clear on what's taxable and what's not. So typically the main ones, JobKeeper is taxable, whereas Cashflow Boost and JobSaver in New South Wales isn't taxable. So we should be mindful of that in terms of tax planning and our calculations and what's in and what's not from a government grant perspective. Also need to be mindful of how we get those funds out of a company. So particularly for smaller companies where you might be paying or taking all the profit out, you've got to deal with how do you get that Cashflow Boost or JobSaver component out of the company, because you might have the income tax exemption in the company, but then to get it out, we've got to then deal with that and potentially be up for tax on dividends or potentially an unfranked dividend there. So you need to be mindful of that one. Accruing business expenses. So this is really bringing forward expenses. Any gross salary that we have for this financial year. So say we do the last week of June is paid on the 1st of July, we can bring that in and accrue that this year. Directors' fees. So there's a nice strategy there that we can potentially accrue directors' fees and bonuses this year. So if there's a proper resolution made and it's properly documented that there's a committed amount in terms of a director fee or a bonus, for example, then it can be deductible this financial year to the company. And if it's not paid until next financial year, it won't be accessible to the individual until next year. So that can be a nice timing strategy in terms of getting a deduction this year and it not being accessible to the individual until next year. But you do need to have proper resolutions in place by 30 June for that one. Commissions there as well, bonuses I mentioned, and accruing rent and interest expenses there, making sure we're bringing everything in we can there. Maximising prepayment deductions, which I covered off briefly earlier, any prepayments that come in. Super contribution, so for business owners there, make sure you pay your super for the June quarter before the end of June for it to be deductible this year. So June quarter superannuation isn't due to be paid until the 28th of July, but superannuation is only deductible in the year that it's paid, and specifically when it's received by the super fund. So really suggest that super is paid at least a week before the 30th of June. If it goes through a clearinghouse, which most are now, they typically take a few days up to a week to process for it to reach the super fund itself. So I have seen recently where an employer company had paid super on the 28th of June, I think it was last year, but it didn't hit super fund until early July and they were denied the deduction. It's not deductible last year. So need to make sure we get that in. Reviewing trade debtors and write off bad debts. So that's a pretty straightforward one. Just make sure you're on top of your debtors and any that are potentially bad there, writing them off and getting the tax benefit of that this year. How we recognise revenue, so deferring income there, or deferring invoicing, sorry, from June into July, splitting off any income in advance. So if you've received income in advance and you haven't earned that revenue, we can split that out and not be taxable this year. Trading stock, making sure that we're valuing trading stock as best we can, and there's some options there in terms of how to value stock. And if you're an SBE, you can use the, if there's less than 5K in stock movement, you can ignore. Year-end stock taken, work in progress, so just making sure you review that. Just conscious of time, we've got 12 minutes left and there's still quite a lot to get through, so I know I'm going pretty fast, but really just want to cover as much as possible. Okay, so some more strategies. Paying wages to children over 14. So if they're genuinely doing work for you, you can pay them wages and they're taxed on it at normal adult rates and not penalty minor rates. Travel allowances, which I mentioned earlier, where an employer can pay them to the employee, they'll be deductible for the employer and tax-free potentially for the employee. Professional expenses are now deductible in the year that they're incurred. Previously, they were only claimable over 5 years. And then there's a small business income tax offset there, which is available there up to $1,000 if that's relevant. Normally the tax systems that, normally the tax return system that is used will calculate that typically. Other strategies there, utilise an SMSF to acquire business premises, and you can borrow within super to be able to do that. So that's a very common strategy to acquire an investment asset that is used in the business and you've got control over it, and a good way from a wealth creation perspective as well to do that. So if that's something, if you're looking at buying business premises or premises that you're looking to run a business out of, perhaps considering using your super fund might be worthwhile there. And certainly potential great tax benefits of buying within super as well when you eventually sell. And there is a potential stamp duty exemption there. So if you do have a business premises within an individual name, for example, and you sell that into your super fund, potentially there is a stamp duty exemption, certainly within New South Wales on that, because the underlying beneficial ownership, it's going from your name into the super on behalf of you, hasn't changed. So there's a potential stamp duty exemption. So a nice strategy to be able to get an existing business premises into super and avoid stamp duty on that. Minimising non-deductible debt, maximising deductible debt. So something that we should always look at is what is your debt position? What is your non-deductible debt, your private debt? What is your deductible debt? Can we convert any non-deductible into deductible? That can be sometimes done via restructures but need to be careful not to taint deductible debt. So always keep them separate. Ideally have separate loan accounts set up. So if you've got a facility on your home, for example, you really want to have them separate and have a $100,000 investment loan and a $100,000 home loan and keep them separate. In that case, you can keep the investment loan interest only, keep it at 100K, and then you can pay down the home loan, get rid of that as it's not deductible, and then we maintain the integrity of the 100K. If you've got an overall one facility for 200K and you've got a combination, then it's got to be paid down in ratio. So not ideal there. So we really want to make sure we don't taint the loan and that we maintain its usage and character there. Foreign exchange there, if that's relevant, typically only taxable when realised, and then eligibility for R&D. So if that's relevant for you, although it can create a franking account issue, so there's an opportunity there to restructure potentially when a new entity becomes profitable. That basically means that the franking account goes quite a bit into negative because of the R&D tax refunds, and that you don't have a franking account balance to pay dividends in future. So whether a restructure there might be relevant for another R&D entity. Okay, what else have we got? Non-deductibility of non-ABN payments. So always make sure you've got ABNs on invoices, because if you don't, you're supposed to withhold tax, and if you haven't, it's non-deductible to you. Same with salary, wages, director fees, contractor payments. If you're supposed to withhold tax and you haven't met your obligations, then those payments are not deductible. So that's a big one. Need to make sure your withholding obligations are up to date to ensure deductibility of those payments. Late paid super, I haven't mentioned that. If you pay super late, so after the 28th of the month each quarter, it's not deductible at all. People think, oh, you're just up for late penalties and interest, but still tax deductible. It's not. The whole lot's not tax deductible. So it's a huge, huge penalty with paying super late. So if you're going to pay one bill on time, make sure it's your super. Make sure you're paying that at least every quarter on time. Make sure it's deductible, because if it's not, you're supposed to lodge a superannuation guarantee charge form, pay penalties, pay interest, and then the whole amount is not tax deductible. So that's a huge, huge one. Inter-entity transactions. So that's where we can assess profits within a group and make sure we're optimizing within the group there. Professional practice business and PSI. There's some recent changes around that and making sure that salaries and distributions are within the acceptable ATO levels. So if that's relevant for you, need to make sure we have a look at that. And then private companies and Div 7A loans, which we've pretty much already covered there. Okay, small business CGT concessions, just covering at a very high level what these are. They're very complex, but should really need to be aware of them. So when you're structuring a business, this is sort of starting with the end in mind in terms of what could an eventual sale look like, and are we structured to make sure we're potentially going to be eligible for these concessions. The other thing to be mindful of as we do grow, it might be worth considering a restructure whilst we're eligible before we become ineligible. So the two main thresholds there are turnover of under $2 million. So if you're getting towards that, might be worth thinking, should we look at a restructure and utilize some of these concessions, or on assets under $6 million. So your entire assets, excluding your home and super, but often that can be primarily the business or other assets, investments that you've got. So if you're getting towards either of those thresholds, might be worth considering restructuring to trigger those concessions. What that basically means is we trigger a gain. We pay tax on that gain, but applying the concessions, we can reduce that tax to potentially quite a low level, if not nil, and then we lock in a cost base. So if we might lock in a cost base of $2 million tax-free, and then when you sell in future for $3 million, you only be up for tax on the $1 million above the $2 million rather than the whole $3 million. So just some opportunities there in terms of structuring and restructuring. Okay, next one, R&D tax offset. So this is relevant, obviously, if you're undertaking any R&D activities. Quite an attractive offset. You basically get back 43.5% of eligible expenditure, and it can be in the form of a refund. So under 20 mil turnover, that's going to be the bulk of us. That'll apply. So yeah, certainly consider that if you are in that category and claiming that that offset. Very attractive. Okay, so this is a quick diagram in terms of correct corporate tax rate. Basically, were you less than 50 mil? If you were, was the company's BRE passive income greater than 80%. If it was, you're at the 30% tax rate. So basically non-trading entities or investment entities typically are going to be at the 30% rate, or if you're a trading entity, small business entity, you're going to be at 25 there. And then lastly, in terms of the business section, just the tax-free status of COVID grants. So this has been a bit of an uncertain one up until recently in understanding which of, particularly the New South Wales government grants and other state-based grants, whether they were going to be taxable or not, but it has been confirmed that they are now non-taxable. So the business grant, New South Wales business grant, New South Wales Job Saver and the micro business grant are now not taxable, which is great news. Okay, all right, still got a bit to go. So quickly we'll scoot through pensions. So why get money into super? I covered it earlier. Basically, it's the lowest tax structure, 0% in pension mode, 15% tax otherwise, 10% on CGT. So concessional contributions, again, I've covered 27.5K is the cap for everyone now. And there's the additional Div 293 tax if you're above 250K, so need to be mindful of that. And we've got the catch-up contributions, which again, you can make up to 4 years contributions there, potentially up to 100K this year if your balance is less than 500K. So that's a big one, which I did mention earlier. So non-concessional, which is non-deductible after-tax contributions. So basically when you want to top up your superannuation, but you're not getting a tax benefit or tax deduction for it, the cap is now 110,000 for everyone under age 75. But once you go above a super balance of 1.7 million, you can no longer contribute non-concessionals. There is the 3-year bring forward rule, so you can get up to 3 years worth, 330,000 into super. So this is really retirement planning when we're getting into our 60s and getting towards retirement. How do we ideally get as much as we can into the superannuation environment? So yeah, if that's relevant for you, certainly can dig into that in more detail. What do we got here? Spouse super contributions and contribution splitting. So there's a tax offset of up to $540 on contributions that you make on behalf of your spouse. You can also split up to 85% of taxable splittable contributions with your spouse. So why would you want to do this if you're wanting to equalise your superannuation accounts? And the reason being is each person can have up to $1.6 million in retirement phase. So if there's one main income earner that's got the bulk of their money in super, how do we ideally top up the non-main income earner that mightn't have as much in super to make sure we're utilising the caps and thresholds? So we'll skip through that. Super co-contributions, again, if your income's below, well, this is a different one, sorry, if your income's below 56,000, you can potentially get a co-contribution from the government for up to $500, or yeah, if you contribute up to $1,000, so a small one there to be mindful of. Downsizer, so this is if you're selling your home. This can be a good way to get extra money into super for those essentially above age 65 at the moment, but that's reducing to age 60 from the 1st of July. And also the ability to get money into super with no work test, which is in there at the moment. So if you're over 65 at the moment, you have to pass the work test to get money into super. Whereas under this type of contribution, you don't have to pass the work test. And also, yeah, above age 75, there's no upper age limit. So some considerations there. We need to be mindful of age pension and Centrelink. If you're selling your home and got a lot of money in your home, typically your home is exempt from, and your residence is exempt for Centrelink purposes for asset test. But once it's sold and money goes into super, it then becomes counted for the asset test purpose for Centrelink and age pension. But really something to be considerate of if you're age 60 or above and selling your home. So some more details here. I won't drill into them, but basically $300,000 per individual. So a couple can potentially get in $600,000. And there's a nice example coming up, which I'll get to shortly. But pension. So if you're in pension mode within super, make sure you're paying the minimum pension. Otherwise, you breach the pension rules and you lose the tax-free benefit of the pension. And pension payments have been reduced by 50% for the current year as well. So we don't have to take out as much. So this is a quick client example. So just really to show the ability of getting, maximising what we get into super. So this was a husband and wife who had an $8 million home. They had $2 million in super and they had a $500,000 business. So they were looking to sell the business, and we'll be able to apply the small business CGT concessions and make a 500k retirement exemption contribution, so 500k into super. They were also looking to downsize their home, so they'll be able to make 600k downsizer contribution, 300 between each of them. And then they're going to use excess cash from the sale of their home to make another 600k. Two lots, that would actually be 660 now potentially. Two lots of non-concessionals. So in this case, when it happened, they were able to get 500k plus 600k plus 600k, 1.7 million into super. So they already had 2 million, so were able to get another 1.7, and it was roughly evenly split between them. So 3.2 million of that will be in pension and effectively tax-free for them. So really great outcome in that scenario for that particular client. Okay, we're on 12 o'clock, so we are running over. We are recording it, as I mentioned, so anyone that needs to leave, feel free to do so and you'll get the recording, but we've probably got another 10 minutes or so just to get through everything, so I apologise for that. So 1 July changes affecting individuals. So there'll be a one-off extra $420 back in your FY22 tax return on top of the existing low and middle income tax offset, which equates to $1,500 basically. So when you lodge your return, if you're below the 126,000, then you're going to get a tax offset there, which is nice budget announcement there for everybody. Superannuation guarantee is increasing. So at the moment it's 10%. It will be going to 10.5% from 1 July. So just an extra 0.5% cost of payroll there for employers. So bear that in mind when you're talking to your team, that effectively that's an increase for them as part of their package. They will be getting an extra 0.5% super, and then it will be increasing to 12% through till 1 July 2025. What else we got? First home saver super scheme. So this is for maybe children or younger clients there who are looking to get into their first home. Can potentially get a benefit from contributing into super and then being able to withdraw up to $50,000 from 1 July to be able to use to purchase a home. So there's an annual limit of 15,000, but that can be a nice strategy for first home buyers there to get a benefit of contributing into super to use for the purpose of buying a first home there. Okay, so 1 July onwards changes affecting businesses. So the 450 super guarantee threshold has been removed. So there's super guarantee applies to everybody now, except for those under 18, unless they work more than 30 hours a week. So just make sure your payroll systems are accommodating this, which hopefully they all will automatically there. Profits of professional services firms. So again, if this is relevant for you, we just need to be mindful of how we're allocating that income and making sure that the primary individuals are basically getting a level of income that the tax office are happy with and want to see. So yeah, if that's relevant for you, we need to have a look at that and have a look at the risk factors involved and where you ideally need to be sitting and where you sit in terms of what you're currently taking from an ATO risk perspective. Another one here, which was a recent budget change, was lowering income tax instalments for business and PAYG. So they've set the uplift factor at 2% instead of 10%. So basically means that your instalments aren't going to be as high this year as they otherwise would have been. So not a, well, depending on your instalment level, possibly not a huge one, but maybe for some, but basically enabling you to have more cash throughout the year. But obviously doesn't change the overall tax that you're going to pay. If you don't pay enough instalments through the year, then you're going to have tax to pay at the end of the year on the return. What have we got here? Trust distributions to companies. So again, relates to what I was talking about earlier, making sure that we're properly dealing with distributions through to companies and unpaid distributions and whether we're going to have any issues with those. So again, if that's relevant for you, we should be looking at that and how that applies to your situation. Div 7A, I won't drill into this. These were proposed changes which were coming in but still on hold. So again, if Div 7A is relevant for you, really from a planning point of view, just be mindful of this. These changes could be coming in. They've been spoken about for the last few years and haven't come in as yet, but maybe coming in depending on what the Labor government certainly decide to do. So just something to be mindful of there in relation to Div 7A. Okay, we'll jump across into changes regarding superannuation. So the first one here is the work test is being repealed. So those under 75 now can make or receive non-concessional contributions, including the bring forward rule or salary sacrifice contributions without needing to meet the work test. So previously, once you're 60, well, at the moment, once you're 65, you need to be able to pass the work test to make contributions into super, but that's being scrapped from 1st of July. It will still apply, however, to personal deductible contributions. So if that's relevant for you, again, let's have a dig into that to see how that affects you. Downsizing contribution, which I pretty much already covered, it's reducing from age 65 at the moment down to age 60. So I don't need to cover that much more. And then the reduction in minimum drawdown, also 50% of the normal pension amount, which I covered earlier as well. Okay, we're getting there. So just to wrap up, we'll finish up with, I suppose, is the recent federal election and what are some of the proposed Labor policies that may come in that might be impacting us. So firstly, which is quite a big one actually, is electric cars. So the proposal at the moment, and none of this is legislated, but the proposal at the moment is that from the 1st of July, no import tariffs and no FBT for electric cars below the luxury threshold. So that's a big one. If that's something relevant for you, if you're looking at buying an electric car, it's potentially going to equate, firstly, a cheaper purchase price, a couple of grand there potentially on the import tariff reduction. But up to, I read an article this morning that had done a calculation up to $9,000 a year annual saving because of the FBT exemption now. So it basically means that employees can salary package an electric car without any FBT consequences. So there may be zero business use. Ordinarily, that would attract FBT, and we'd have to do an FBT calculation, which would typically negate the benefit of salary sacrificing, or certainly some of it. But now, under this proposal, they can potentially salary package an electric car, no FBT on it, and basically get a tax benefit out of packaging that car, and it can be fully private. So it's, again, not confirmed, not legislated, but that's a big one if you're looking to purchase a car, and particularly an electric car. You might want to hold off until after 1st of July potentially and see whether this comes in. Second one there is a $1 billion critical technologies fund. So that's more from a business opportunity perspective, that if you're within the area of tech and AI and software development, there's going to be a lot of money in the pool there to access. So whether that's something worth exploring for you or your business. Super home loan scheme has been ditched and replaced with Labor's Help to Buy scheme. So that's relevant for people trying to get into the property market, where the government would be essentially buying 30 to 40% the property with the owner, and then that property could be bought off the government by the homeowner over time. So interesting one to be mindful of there for some people. Labor announced last year that it would be supporting the final stage of tax cuts if it wins the election. So anyone earning between 45 to 200K looking to pay 30%. So that's a future proposed tax cut there. More generous childcare subsidies, so increasing the subsidy cap there. So those with kids in childcare may be relevant for you. And they've also agreed to proposed to match policies on freezing deeming rates for pensioners and other payments, as well as the eligibility for the Commonwealth Seniors Health Card. So I know we've had clients that certainly want to check their eligibility for that. It's based on income and can be quite beneficial financially to have access to that. So something to be mindful of there. As I mentioned, these are not effective until enacted by the incoming government there.
We just had a quick question from Addie. How much could I borrow from my super to buy my first home? Could I use any part of it or only above mandatory 10% contributions of the employer?
So short answer is you can't acquire a home using super. So superannuation, members of a super fund can't benefit from assets of the super fund. So you can buy an investment property within super, but you can't enjoy any benefit from it. So whether it's a home, whether it's an investment property, you can't use it at all to live in, to use as a holiday home. Unfortunately, it can't be used and purchased within super for that purpose. Okay, so future of tax changes announced by the previous government is unknown. So there's a couple of ones here around the downsizer, the digital games tax offset, 30% refundable tax offset for qualifying Australian expenditure, development expenditure on eligible games. So that's relevant for you as a developer. Car parking fringe benefits, if that's relevant, if you're paying FBT on car parking. And then this one, which is not yet law, subject to decisions from the government, are two of these boosts, technology investment boost and skills and training boost, which is basically a bonus 20% claim on expenditure. So the way that works is, and it can include things such as cloud computing services and software and other training and education. So if you were to incur $100 this year, this would mean you would claim a bonus 20% or $20 next financial year, and then the same next financial year. So I'm not quite sure why they've deferred the bonus until next year, but that's something that we'll certainly be looking at as part of FY23 and any eligible expenditure there. Focus areas of the ATO, they are looking at record keeping, work-related expenses, rental property income and deductions, and also crypto is another big one at the moment that they're honing in on, making sure people are paying their fair share of tax on their crypto investments. Okay, all right, we are pretty much there. So really just to summarise, making sure we understand the tax environment that we operate. There is so many strategies as I've been through today, and there's always changes to tax rules in legislation. So it's really important to be across it when running a business. So otherwise, that's about it. So if you have any questions or need any help, feel free to put them in the chat. Happy to hang around now for some questions. Otherwise, also happy to offer a free advisory session for anybody who's not a client at the moment to offer a second opinion or review of your affairs or anything that we've covered today here at all. More than happy to do that. So feel free to reach out, call the office or email through, and we can book that in. And just a reminder, everybody who registered will be getting our tax minimisation guide and a copy of the recording.
Mark, we had a question earlier on. We hear improvement in leasehold asset can be claimed as full expensing, or do we have to follow Division 43?
Let me just have a look.
So that was a bit earlier on, just under Steve Duffy's question.
Okay. It depends on the improvement. Typically, if it's an improvement, it's probably going to fall under Div 43. But really, we need to assess whether it would be considered an improvement or a repair, likely in that scenario. Okay, otherwise we'll wrap up there, everybody. Thank you so much for attending. Appreciate your time, making the effort to be here today, and hopefully you all got something from it. Hopefully it was beneficial, and look forward to hopefully speaking with you soon. Take care. Any questions at all before we wrap up? Any other questions?
I think that's
all good. Okay. Thank you, everybody. Have a great day.